Hi there, it is April 3rd, 2018. This is Dan Kurz, DK Analytics. We're coming out with a video update. A lot has happened in the last month or so, as you're all plenty aware. We'd like to take a look at some of these things and in so doing touch on the U.S. consumer, U.S. and global debt, the budget deficit, the U.S. budget deficit, trade, and the bond and stock market, specifically a sustained disconnect notwithstanding market turbulence, the decline in the U.S. stock market in the recent few weeks, where we've had concerns of various sorts, including even some fundamental ones, lo and behold, including trade-related issues and so on and so forth. But we'd like to take a quick walk through this and start off with the U.S. Consumer. And before we do that, we would like to state that the bond and stock market valuation disconnect, the bubble of that U.S. bonds and stocks are in, is basically a global thing, because we have global financial repression, we have global suppression of interest rates, we have global money printing, which seem to be ending for the moment, but we're going to suggest as we continue to, because the toxic public policy stew that we have on offer globally, that this is not going to be easy to withdraw, because we're not back to solid, sound money. We're not back to property right protections. We are not back to a trajectory called free market capitalism, which is the true wealth of nations elixir, and is especially needed today in an era where we're having more and more difficulties getting enough dense energy, oil-led energy out of the ground at a reasonable cost. And as we've also discussed, the entire output of the globe is dependent upon leveraged output, OECD countries and developing nations that want to ramp up in productivity. If we don't have that, we don't have the machines, we don't have the productivity, we don't have the output per man hour, and this too hangs over everybody's head. But one more reason to gun the printing press, to hit the printing press, and get them rolling, and we suspect that this will be revisited sooner rather than later. But in the interim, we have some fundamentals to pay attention to take a closer look at, which suggests that, again, that this disconnect between valuations of bonds and stocks and the underlying fundamentals just is as big as ever, notwithstanding the recent stock market turbulence in the U.S., where leading indices are off about 10% from their highs. They say that the U.S. consumer is 70% of the economy, that is GDP. And if that's so, then we should pay attention to something. We've drawn to your attention a rapid decline in the U.S. personal savings rate. The same applies also to the U.S. net national savings rate, that is savings of households and corporations compared to gross domestic income or gross national income. And it's down at a low water mark of 1.3%. And we have a couple graphs I'm going to bring to bear here in this video to show this. Bear with me again as I go through this. But if we see this here, we used to be up here. Right, this is over a 60-year period, 55-year period, in essence, since the end of World War II. And what we've seen is the net savings rate of households and corporations in the United States keeps going down, 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 which suggests that the funding growth, working capital, and CapEx is going to be increasingly based upon, yep, you guessed it, continued access to foreign funding. And this is all the more true as the U.S. federal government deficit is expanding massively. You know, we're at a run rate today of, and I'll get into that, of 1.25 trillion annual run rate. You know, more than double roughly the figure of the last fiscal year on record. And that suggests that we have a dissaving going on at the national level, at the individual household level, and increasingly at the corporate level. Just think of all the debt increases from $3 trillion to $3.5 trillion 7-8 years ago, corporate debt to over $6 trillion today, and a lot of that was used to, you guessed it, buy back stock, and we're going to get into that as well. But this is not this 1.3% U.S. net savings rate, coupled with an expanding deficit and growth in the trade deficit, does not speak volumes about a sustainable, healthy, self-financing U.S. economic recovery, if that's the right word. We've actually been in a recession since '08. We never came out unless you look at the GDP statistic, and even if you look at that, you take out the massaged inflation rate with a real world one, and you can argue we've never been out of it. But why do I mention all this? Oh yes, the reason is this: because the talking heads on CNBC and elsewhere that are perma bulls on stocks, and by extension have to be on bonds as well, because the two are tied at the hip valuation wise, they keep on telling us why the stocks that are priced for perfection are justifiably priced that way, and by extension bonds. Speaking of bonds, speaking of U.S. Treasuries, a few days ago, there was a report I came across of I think a Merrill Lynch analyst that wrote a piece stating that U.S. Treasury, the 10-year U.S. government bond, yielding about 2.7% currently, is the most undervalued asset in the world. Now, think about this, and we're going to bring this in here with a U.S. debt, total public debt. Let me frame it first, having you look at this. And remember, the amount of debt has increased smartly. Right here, we started here. Now we're at over $21 trillion. This is just U.S. federal debt, and this is since 1968 or so. So we've had this massive explosion, which has outstripped GDP growth, nominal GDP growth, massively, right, over the same time period. That's why debt to GDP today has crossed 100%. That's just public sector debt, versus 33% when Paul Volcker did tough love and brought the federal funds rate up to 15%. And we had a 10 and a 30-year long bond in the midst of that inflationary battle, stagflation that Paul Volcker tried to deal with, wherein he said, all right, we're going to drive it up to nosebleeds level to get this inflationary bias and expectations out. If we did that today, we would have an absolutely untenable, unfinanceable situation, because we have way too much debt. And that debt, frankly, will continue to constrain the ability to do creative things. But you wouldn't think so, because the way that this government is spending, and I'll get to that, and the way everybody believes in this, cutting taxes and increasing spending, and that this is the way to paradise, makes you really wonder. And that in turn is, again, part and parcel of why we have this mania in stock and bond valuations. But it's just incredible. For an analyst to come out and state that a treasury yielding 2.7% is the most undervalued asset in the world, when in fact it's a junk bond without a junk yield. There are huge solvency risks. Okay, you rightly say America can print the money. Well, then you just have monetary inflation-based default. In other words, your money buys nothing, and then when you translate it over into a foreign currency, you get an additional kick in the pants. So, inflating away a default risk is just another way of putting it, or is a longer-term proposition, but it's at the end of the day the same thing. You lose purchasing power of the savings you set aside. Instead of having a return on capital, not to mention a return of, in terms of buying power, you have the opposite. Speaking of, I mentioned the U.S. deficit a couple times, debt. We crossed the $21 trillion debt level, right? That's up again by 1.25 trillion. That's our run rate annual deficit right now, the United States government, $1.25 trillion. And let me take a look and show you. I showed you I got the debt picture up here one more time, just so you have an idea as to how in hoc, and this is just the U.S. government, we are, and what kind of impact at $21.5 trillion, thank you, Fred, or Federal Reserve, for this, what kind of an impact higher rates would have, what kind of impact higher rates would have. And that impact just on the U.S. government debt, as we've talked about in the past, is simply this. 1 percentage rate increase in the cost of financing the U.S. government debt, much less the $68 trillion that America owes, or the $233 trillion that the globe owes collectively, right? I mean, you have two sides of a balance sheet. You've got a creditor and you've got a debtor. Well, those claims are owned by someone, but they have to be paid by someone or repaid, and that's the problem. That's the rub. With so much debt, you have huge problems making good on outstanding principal repayments, much less servicing interest. And when those interest rates go up and the refinancing gets more expensive, you rapidly run into tremendous debt-carrying issues because the price of money is obviously expressed in the interest rate, or the price of capital. And what happens here in the U.S., if we just drill down to the federal government level for a moment, what will happen when the recession that I'm going to argue we're already in and have been in, again, understated inflation, the main aspect, what happens as the recession deepens? Tax receipts slide, not only related to the tax deal, but what happens also when the recessionary payments of the government, unemployment checks, more welfare checks, more transfer payments to soften the blow, along Keynesian lines of a economy that's slowing down or going into recession? We're going to have recession deepening, lower tax receipts, and more government outlays. And in that sense, and we've said this before, we've mentioned it in prior videos and posts, we could easily see, in our opinion, a $2 to even $3 trillion U.S. government deficit. I mean, look, we spiked from something like 660 to a run rate of 1.25 trillion last 12 months in a period where we're supposed to be having accelerating economic growth, which really isn't true, but we'll get there. And if we now add to that a trade deficit, a goods deficit of about $800 billion a year, and an export surplus in services of about $200 billion, but if we add, let's just stick with the $2 trillion budget deficit, U.S. government, federal level, $600 billion trade deficit, about $600 billion more that the Federal Reserve wants to throw onto the market, that is, shrink its balance sheet out of $4.5 trillion at an annualized run rate of $600 billion, then lo and behold, we're looking in the very near future at roughly $3.2 trillion in treasuries that the market has to absorb for those three reasons. And this, by the way, is prior to the petro yuan really getting up and running. We've mentioned and continue to mention over the years that the mismanagement of the American currency makes it a bad reserve currency. It goes down over time against all other currencies, and as such, people are sick of bearing the brunt of the dollar mismanagement. It reduces foreigners' savings when they translate it back into their home currencies. So there's political reasons, there's economic, financial reasons, but suffice it to say that this will be another long-term negative undercurrent to the dollar's trading value, and thus the need for people to have dollars to trade oil or anything else. But that is more of a long-term, which could accelerate at any point, granted, but that just is another nail in the coffin of too many dollars, all right? being entered into the world by the expanding unfinanceable U.S. deficits, the lacking savings of Americans to mop it up with, and the trade deficit, and now increasingly a Fed promise to jettison $600 billion worth of bonds, the QT, quantitative tightening. Well, the question is always, at what price, right? At what price will people be ready to lend America more rope to hang itself with financially, the U.S. government? Let's take a look at this. This is a Treasury yield over let's see, since 1965, so we're looking at over 50 years of history here. And what we see is the peak. This is Paul Volcker Tough Love, early 81, 15%, 10-year and 30-year rate. And the federal funds rate north of that, I think it was 18, 19%. And we've had a 37-year run here, a bull market in bonds, declining interest rates. Interestingly enough, and this is just a coincidence, we mentioned in a report, we also had a 37-year bear market in bonds. If we believe we're near the bottom and the American currency has been thoroughly mismanaged with ever-growing default and monetary inflation risks, which especially threaten foreign creditors, then we have to assume that the cost of financing has got to rise over time. And again, if you're running at the 21 trillion debt expanding by north of 1 trillion a year, the federal government, every 1% increase is going to cost you an additional $210 billion. And because America didn't take advantage of the long period of below average bond yields, it has failed to lock in over 30 years a lot of that debt that's going to come due. And in fact, the cost of financing America's debt, if we look at the interest expense, I'll get to that in a slide, is something like $140, $150 billion a year. And the problem is, it's $263 billion a year, and it's 1.4%. That's the average cost of financing. Think if the cost of financing averaged 2.4%. We're at 2.7 now. And the government doesn't have a long duration book. It has rather short durations, 5-6 years. So this debt needs to be refinanced, and every 100 basis points or 1 percentage point higher interest expense will increase government interest expense by $210 billion, and it will be manyfold of that if we take a look at the entire U.S. debt structure, which is nearly $70 trillion, as mentioned before. So we got an extremely interest rate sensitive economy and government, and we don't think that the current level of interest rates is sustainable. That is, it's going to drift much higher, and I think it'll overwhelm economic recession, the safe haven trade, simply because at today's stage, the default or the monetary default risks, if you will, are so huge. So if we consider the fact that holders of treasuries, the rest of the world, which have in aggregate, there's over $16 trillion sloshing around the rest of the world. If we consider that they're going to either want a higher interest rate to finance what they can see is a fiscal policy, a trade policy that is not going to protect the value of their dollar holdings. If anything, it's going to dilute it. But we have a reckless fiscal policy, a widening trade deficit, and a Fed that might do QE. What would you do as an investor, not politically, but purely based on economics and finances and on returns? You would front run the Fed. You would front run rapidly increasing government deficits. You would front run a growing trade deficit, meaning you'd want to sell. You'd want to get out of Dodge. You'd want to go and divorce yourself from your treasuries before interest rates or yields are forced up to 3.7, 4.7, 5.7, and even higher to protect your capital, to get out of harm's way. Everybody's going to sell if they know there's a huge supply coming of what they're selling, because they know it's going to drive the price down. Well, to drive the price down at treasuries, how do you do it? You increase the yield. And people are going to demand more for the heightened solvency and monetary inflation risks that the policy of the country and the trade situation and the Fed policy dictate. So what does that also suggest? I think in pretty clear terms that it suggests pressure on the dollar, because if the American government needs this financing, the Fed wants to unload dollars, we need the money to support this huge trade deficit, we're going to see more dollars come onto the marketplace, and America's going to have to issue more dollars. People are going to want to sell more dollars. How are dollars sold? In the form of treasuries, mostly in the form of treasuries, some agency bonds. But if there's an avalanche of dollar supply coming, you want to sell before that avalanche pushes down the price of what you own, which is, in this case, a U.S. Treasury. This also suggests, obviously, dollar weakness, because if people sell treasuries, what are they selling? They're selling dollars, or vice versa. It's the same thing. And this suggests more inflation for the United States as the dollar loses value. Stagflation, 1970s on steroids, I think it's a damn good bet. The U.S. federal government deficit, that is its budget. I mean, the federal government, which has run deficits for virtually forever, that's why we have 21.1 trillion in operations debt. Forget for a moment the fact that if you discounted back the commitments on Social Security and Medicaid and government employee pensions, you'd be, depending upon whose numbers you want to use, north of $110 trillion. Some estimates even point to over $200 trillion. But if we focus on this mess we're in and that debt, we're expanding that debt to the tune of $1.25 trillion currently, and yet a GOP Congress, supposed to be the daddy party, the party of fiscal discipline, well, once upon a time maybe, but not today, they have sent Trump a budget which features a 13% increase in discretionary spending. Discretionary. The U.S. budget, the federal government budget, is divided up into two camps. It's called mandatory, which is about 70%, and discretionary, which is about 30%. And that 30%, which is the military spending and a lot of other things that can be modulated, but if the party of supposed fiscal restraint can't show any restraint on the back of already huge deficits and increasing economic weakness, well, when is it ever going to be possible, right? The only place where you can go is in the mandatory spending, but if you can't cut the discretionary spending, you don't even have the guts or the will or the sanity or the concern for future generations, that is not handing them nothing other than debt, then you got to ask yourself, well, when then? Here is from the CBO, the Congressional Budget Office, a chart of the situation, and this might be too small to hone in on, but here it is. Here's the source. Source is right down here, cbo.gov, all right, system files, 115th Congress, and discretionary spending, you see that 1.2 trillion? That's 30% of 4 trillion in spending, meaning the rest is from over here. That is the discretionary spending. That's supposed to be relatively easy to cut, but they can't even cut it in the midst of a deficit that is, you guessed it, expanding rapidly. This augurs very ill for any kind of spending restraint in the future, spending discipline. And with the GOP controlling the White House and both chambers of Congress, and this is the best they can do, Well, the question is, when can we hope for any kind of sanity on the spending side in Washington, D.C.? And there are two answers. When economic Mother Nature forces it, that is, when interest rates go to the moon and the junk bond status of U.S. debt is recognized for what it is, or when the Democrats retake the Senate and the House. And in so doing, they will accelerate the path towards financial Armageddon, quite frankly, unfortunately. But if we don't have the spending restraint now, the Democrats will take it up another notch, and then ultimately the bond vigilantes will have to kill this whole prolific spending. There is nothing else. But what does this portend for future reckless spending and even bigger government deficits? It portends a bigger problem as the Democrats regain control of one or two chambers, which frankly I think is but a given based upon the grotesque mismanagement of the fiscal side of things by the Republicans. And then it's very likely, in fact, that a lot of blue states, Illinois, New York, California, which have huge deficits themselves, and they have debt issues which they've been managed to camouflage, and they have broke public sector pension plans at the state level. These all are also going to be asking for some kind of bailout. Now, this isn't just in America, it's an OECD problem, but America has the Achilles heel of having had the leading global reserve currency with which to hang itself financially, with which to run up absolutely unpayable bills, right? That's why in a relative sense, and you can see it also in the current account deficit, in America's $8.5 trillion net debtor status, that it is much more vulnerable because it lacks the domestic financing to stay the course, right? The question here is the dollar, anyone. What does that mean for the dollar going forward? And I don't think it means good things. And as the dollar goes, so treasuries goes, because that's how you buy dollars. So what this means is that the current valuations in bonds and by association stocks are just outlandish, right? And they could get even more outlandish. I've said this before, and they have for a long time, but at some point we're going to have a break. We're going to have a reset back to reality, and then we're going to have not regression to the mean, but beyond the mean, as a couple of my posts and videos have tried to show and display what history does. There is no reversion to the mean, there's only a reversion beyond the mean. But this could bring inflation as American dollars or dollars come home to America to make things more expensive for American citizens that shop at Walmart. And I'll get to that in a moment. I shop there as well. Grew up Catholic, so there's a confession. There's a lot of good deals. And then you look at where it's made, and then you wonder how sustainable it is. But this is going to come home to roost in terms of valuations and also inflation. That's the takeaway. So that will reduce Americans' purchasing power and take away any semblance of price stability. Which brings me to Walmart and what's there and where it's made brings me to trade and tariffs. Before I go there, recall, if you would, that the U.S. already has tariffs, or you might not know this, so if you don't, it might be news. The U.S. has tariffs on over 12,000 goods. That is, there's over 12,000 tariffs in place. Let me say it correctly. Very much including steel, and for decades. Yet they keep coming back. The tariff spat appears to be moderating for the moment as China has moved to a mere wrist slap manner in terms of U.S. tariffs on the ag side, pretty much. But that raises an interesting dynamic, and that is this. America largely exports what? Raw materials, agriculture. And the Chinese export what? Largely manufactured goods. I got an unpleasant question. Which is the developing nation here? And as we've mentioned before, this tit-for-tat response, while China has been moderate, could get out of control, depending upon what Trump does and what the responses are. But it has a history of getting out of control because politicians have ego and pride, and it's one-upmanship, and you get divorced from what's sane for an economy, and we get emotional, and so do leaders of nations that entertain or then impose these tariffs. So oftentimes a trade war, which is actually the result of domestic disenchantment or growth issues or lacking income or worse, can and do turn into shooting wars. So hopefully this isn't a prelude to that. But the big question that keeps being bandied about is, does the U.S. economy end up a winner or a loser from such a trade war that escalates? Well, first of all, the entire world, as we know from history, is going to be a loser if we get that. But what if we just keep ratcheting this up over years and it's a slow death of international trade? Which economy is going to get hurt worse? Is it the United States economy, which imports $600 billion more a year than it exports, or is it the other economies, the Germanys, the Chinas, and all the countries that have large trade surpluses? Well, I would argue the following. If America has an $800 billion plus deficit in goods trade, right, with a $200 billion offset with services-based trade, then this country, the United States, is going to be in a weaker position if this thing really gets nasty. Either goods are withheld, the supply chains break, inflation ramps up, and those things will happen. And the casualty will be the U.S. output. It'll be U.S. Citizens and their purchasing power. And the winners will be those slivers of industry or those vertical markets that get all these crony tariffs in place, the type that Wilbur Ross, President Trump's trade or Secretary of Commerce, is so in favor of. But take a look at this, and we mentioned this, or just consider this mentally. If we have a situation where U.S. economic growth is already tepid, we have a U.S. consumer which is already running on fumes, a record low or near record low savings rate. And we introduce all of a sudden higher materials costs, higher cost of goods sold. The other manufacturers, the higher value-added manufacturers, are going to suffer as a result because they're going to have to pass on or try to pass on these increases in the cost of their materials, whether it's steel or aluminum or whatever else is in the pipeline. And they're going to suffer. How so? Because demand will be less for their products. Prices have to reflect the increase in materials costs. The consumer will have less purchasing power, and the domestic high value-added manufacturers from washers, dryers, trucks, HVAC equipment, construction equipment, locomotives, aircraft, they are going to have to mark up the cost of their wares to reflect their higher materials costs. So they're not going to benefit, meaning the broad base of U.S. industry is not going to benefit. Just those select industries that are getting the protection of these trade tariffs, which not the Chinese or the Germans or the Brazilians pay, but the American consumer pays and the U.S. government collects. It's a tax increase. This coming from an administration that wants to reduce taxes. If that isn't ironic, I don't know what. Now, what happens to domestic inflation in such a scenario? Especially if China decides to move more of its huge dollar holdings into tangible assets, right? What happens? Well, you're going to have more expensive prices at Walmart, right? And we have, however, or we are, when we look at this, overlooking something that I think is incredibly important, and that's this. Our trade deficit, beyond import controls or unfair tariffs or unfair trade practices of the rest of the world, those always exist. And America used to have very large trade surpluses for a long period of time, and not just due to World War II. But we need to revisit as a country in terms of policy in the private sector, all right, in the private sector, not with government meddling, but in the private sector through shareholder activism. We need to revisit corporate compensation, the C-suite in particular, top brass, top management, and corporate governance. This is where a lot of our problems are in terms of our huge trade deficit as we outsource a lot of production. How about taking a look at signing bonuses of the top corporate brass in the millions? C-suite executives have already eaten prior to lifting a finger. Where is the value added there? Where are these strategic parallel interests, strategic long-term parallel interests with building better mousetraps and generating organic growth, sustainable growth for their companies, for their shareholders, for all the other stakeholders, including workers and local communities? Well, it's not there. Moreover, annual corporate top management compensation is over 400 times that of an average line worker. Some 50 years ago, it was 40 to 1. Now it's over 400. Now, I ask you, in a rhetorical sense, is there any correlation here between the U.S., which went off the gold standard in 1971, or some 47 years ago, and started to embrace fiat money, which allows for redistribution and cronyism and all kinds of property right theft and inflation, stealth theft, thief? Is there any correlation between that and the huge increase in compensation for the 1% relative to 99%? I think the answer is abundantly clear. It's a resounding yes. So that's where we have to go after things to set this straight. It's like someone that's sick. You don't give them an aspirin tablet. If the headache doesn't go away, you have to look deeper and go after the true cause, not just trying to cover up the symptom. The C-suite execs, by the way, is part of this problem of corporate governance and corporate compensation, which only shareholders should address. The government should stay the hell out. But they get awarded huge options packages at fixed strike prices. Think of that. This makes senior management salivate, understandably, over slash and burn business practices. That is, instead of building an organic growth business, they cut costs, they cut the ranks of enabling middle management and other critical people that make the company function well in terms of production, in terms of customer interface, in terms of marketing. They then fire domestic employees and outsource. And if that wasn't enough, to add insult to injury, they then use the freed up funds from all the slash and burn to do what? Leverage up the balance sheet. Well, combined with leveraging up the balance sheet, they go on a stock repurchase binge, right? Instead of focusing on driving organic growth through R&D, training, investing in people, and CapEx, they do slash and burn. Got to get that stock price up. Those options are in the money. Cash out, and then leave and get ready for the next slash and burn assignment with multi-million-dollar sign-on bonuses. I mean, what does this have to do with value added of meritocracy or long-term manufacturing vibrancy or free market capitalism? Our answer? Absolutely nothing. And that's what's wrong with the U.S. output side. And that's why the U.S., more than anything, doesn't produce competitive goods that it can sell in the rest of the world. You know, about 30 years ago, I met a German at a shareholder meeting, and he said to me, "Oh, you Americans, you focus on getting the stock price right. We focus on getting the product right." And I thought about that. In retrospect, there's a lot of truth to what he said. So This is part of the issue that has to be addressed. We shouldn't have a system, I'm going to call it the crony capitalist system bordering on fascism, that focuses on enriching 1% at the expense of 99%, and in its wake drag down the nation's ability to compete in the global marketplace. While we're at it, and on the trade deficit front, and staying on the home front and what needs to be improved here, America also needs to have litigation reform. Too many ambulance-chasing lawyers. U.S. corporate legal costs are nearly 3 times European levels, and the U.S. also needs to revisit trade school efficacy, vibrancy, beyond military training. But these things take years or decades to address and reform. There's no shock and awe, no macho tweet, no instant gratification, no instant results, just a brick-by-brick adult process. Where did all the adults go? Rome wasn't built overnight. An American manufacturing renaissance won't happen overnight either, Mr. President. Actually, there's plenty of reasons to believe that the rest of the world will increasingly demand real U.S. assets, not junk bonds or treasuries or agency bonds, when it takes American money instead of a good in kind. In other words, instead of a balanced trade situation, it takes debt, and it's going to take that and convert it into real assets. And in so doing, I think the rest of the world, led by China, Germany, and we'll take a page out of Japan's successful book of setting up an American manufacturing presence in the 80s and 90s. In the interim, on trade, on global production, a non-crony adult policy out of the White House and Congress on what truly ails the nation's competitive posture and the resulting trade deficit that results should focus on A, addressing, as I mentioned, plentiful homegrown challenges, and B, this very important, getting American access to the lower tariffs that, for example, Mexico has when it exports from Mexico into the European Union or to select Asian nations, Japan, and possibly elsewhere. In other words, don't start a trade war or raise tariffs, but seek U.S. inclusion in lower tariff regimes. Doing so would reassume America's historical leadership in expanding international trade, not in shrinking it, and it would address plentiful domestic issues in the process because it would set the correct behavioral pattern in place. Finally, trying to size up who has the most to lose in a trade war, we state the following. When I was a child, a teenager actually, my family used to drive from upstate New York to Florida and back. And I distinctly remember seeing Walmart trucks with mud flaps that proudly stated, "Made in the USA" on the back of those. That label is long gone, as is much what is for sale in the non-grocery part of Walmart hypermarkets. It is typically non-U.S. manufactured. What will fill Walmart shelves if tariff situation gets out of control, or at what cost to the U.S. consumer for the benefit of U.S. tax collections and a few industries which benefit from cronyism, that is, tariffs with other countries? The U.S. trade deficit has gone from zero in the in the 70s, when I first remember driving from upstate New York to Florida, into the $600 billion range. And this is in a microcosm reflected by Walmart, the mud flaps, no longer made in the USA, and going in and shopping and looking for things in the non-grocery section and being hard-pressed to find stuff made in the United States. Now, who has the most to lose in a trade war? Again, it isn't the creditor nations that have the huge current account surplus position with the United States. The United States owes the rest of the world about $8.5 trillion. So those creditors on the other side of the ledger are going to, yes, face repayment with inflated or potentially very inflated dollars, but at least they'll have the machinery. They'll have the machinery. Note that because of the lack of machinery, in 1775, right when the U.S. started its Revolutionary War, U.S. leaders or would-be U.S. leaders feared their founding fathers and the framers, they're typically one and the same, but they feared that it would be nearly impossible for the fledgling U.S. to win a war against almighty Britain with all its manufacturing ability, right? And this is why America's founding fathers saw the necessity of establishing a robust manufacturing base. It's called controlling your own destiny. Furthermore, note that the hollowing out of the UK and the French industry in the period between World War I and World War II was one of the major reasons that Germany saw the Brits and the French as being of no consequence. This invited Hitler in. How will a deindustrialized America stand to benefit from shutting down the very imports it will need to rebuild its manufacturing vibrancy? It took the Chinese about 20 years to industrialize. We now need their help and Germany's help to enable, sustain, and fuel a manufacturing revival. The last thing we need, the last thing the United States needs, and you could argue the world because this spirals downwards if it gets out of control, but the last thing we need is a broad-based trade war without a viable independence underpinning manufacturing base, featuring plentiful domestic component suppliers. So, Mr. Trump, try to shed your ignorance, your crony tendencies, and your demagoguery here. Note that candidate Trump was in favor of the ethanol lobbies, and President Trump's disingenuous claims about saving a mere 1,000 U.S. manufacturing jobs at Carrier last year had a side deal on something like page 65 that he signed, which allowed Carrier to increase its Mexican labor footprint by 1,300 employees. So there's a credibility issue here, quite frankly, and there's also an economics issue, an understanding of economic history. And we have a U.S.-loving president that needs to do what? To see through the trade cronyism propagated by the likes of Commerce Secretary Wilbur Ross that do this to enrich themselves and their pals at the expense of American consumers, at the expense of an even less competitive finished goods, high value-added American manufacturing base, and at the expense ultimately of high value-added U.S. manufacturing jobs, both in the domestic and in the export realm. Lastly, as a backstop, what about the U.S. stock market? We've seen it come under pressure, stoking a trade war. We get some signs of mounting economic weakness. But what is the president doing, to the extent that he should, attacking the likes of Amazon on postage costs? Fact is, the United States Parcel Service makes a lot of money from packages, and it loses money on letters. You ever wonder why the FedExes and the UPSs of the world's biggest dreams come true is Amazon? What's with this disingenuous or this dangerous demagoguery? Trump isn't the S&P 500's chief executive. He shouldn't be telling companies where to invest, hire, or whom to fire and where, but he should help reestablish optimal conditions for U.S. workforce expansion. America is supposed to be a representative federalist constitutional republic, not a fascist country. Trump should be encouraging reinstating free market capitalist stuff, such as sound money, property right protections, and litigation reform, instead of more unconstitutional bureaucratic interference. It hasn't worked, and it never will. Big government doesn't work. But it doesn't make, those kind of efforts don't make for good sound bites or a macho tweet. And that's the tragedy of it. What's our takeaway? Gathering economic weakness, downward revisions of historical macro reporting, including much weaker than reported industrial/manufacturing output over a multi-year period, and negative benchmarking likely for both retail sales and new orders in the pipeline amidst building inventories as the storm-related fourth quarter 17 boom threatens to turn into a bust. Not despite all the talking heads touting the huge strength and vigor of the U.S. economy. In short, we could see a Q1, first quarter 2018 contraction. Remember, earnings are GDP growth or shrinkage with huge leverage. With GDP weakening, EPS growth is unlikely, and leveraged EPS declines are likely. With an S&P 500 still trading north of 25 times trailing 12-month GAAP earnings per share, in front of a possibly huge EPS contraction, we'd say it's time to preserve your capital and to trim your equity holdings. We hope you found this of use. Over and out.